Stock selling off here with just around 2 minutes until the closing bell. We've got full coverage for you. Chris Osmond, Chief Investment Officer with Prime Capital Investment Advisors. Dory Wiley, President and CEO of Commerce Street Capital. And our markets reporter, Jared Blickery, is standing by with some of the biggest movers today. And Jared, we saw the selling pick up here in the final hour of trading. And it's been the story all day, but technology continues to lead the way lower.
Yeah, the bond market finally getting the better of tech. Didn't happen yesterday after Powell's presser, but happening today. Here's the NASDAQ off 3%, except for the worst day in 3 weeks. You'd have to go back to February 25th, and you can see we're right at session lows right now. Dow is now down 133 points, also very close to its session lows. S&P 500 off 1.5%. Do want to check in on the bond market here because it's been driving the price action, driving money away from the tech trade, and we can see up here that is the highest in nearly 14 months, 1.73%, and a big move here, 9 basis points to the upside. Also want to check on the VIX because we're talking about that closing 2 consecutive closes below 20, which we hadn't seen in the COVID era, but now picking up, and this might be a bottom in the VIX. If that's the case, then probably a top in equities just in the intermediate term. Not expecting that in the long term, but also a source of consternation today for risk markets, the dollar. The dollar is stronger. Finally, got to take a look at crude oil because that's settled at the lowest price in over a month, trading below $60 per barrel. And you can see this is actually the worst day, down 8%. That's the worst day in 6 months. So here's a look inside the NASDAQ 100 where we see a lot of the carnage in the markets. You can see Apple here at the top. That's down 3%. So is Amazon. Take a look at Tesla. Tesla now testing the lows from last week, actually exceeding those to the downside. So that support no longer holding. We can see that's down about 7% heading into the closing bell.
All right, we got a closing bell, and here's where we're probably going to settle when all is said and done. The S&P 500 down, Nasdaq all trading lower, and they accelerated. The Dow's going to settle down about 150 plus points. The S&P 500 will be off below 60 points. The Nasdaq is going to be off 3%, about 400 plus points. Some of the sectors that were in the green, just one. Financials had been big earlier in the trading session, up about 2+%. They're the only sector that are in the green, and they finished the day up a little over 0.5%. Let's bring it back to our market guests on the eve of quadruple witching, Chris Osmond and Dory Wiley. Let me start with you. I'm going to start with you, Chris, because you make an issue over you got to keep an eye out for quadruple. I always have trouble saying it. You know what's coming tomorrow, the expiration of the contracts. Why should we be worried or not?
Well, to your point, it's interesting. We haven't seen a lot of headlines or attention given to the phenomenon of quadruple witching that takes place every third Friday of the end of the quarter. So tomorrow being that day where the option contracts and future contracts on both indexes and stocks expire. Typically, this is associated with higher trading volumes, see some volatile swings usually at the open and close. But what's really interesting this time around is I think that the Fed's taken all the limelight here is the amount of retail activity we saw really over the course of this first quarter as a result of the Wall Street bets and GameStop and AMC and the like action, a lot of volume trading and option trading there. So it'll be interesting to see what impact that has on the market as those contracts expire and if the retail investor will do anything with those options.
We're taking a look at the action today. We mentioned the selling pressure that we're seeing nearly across the board, but financials, like Adam was saying, bucking the downward trend today. They've had a strong start to the month of March. They've had a strong start to the year 2021. Are you a buyer of banks at these levels? And I guess when you're looking at them, what do you find attractive?
Well, we're finding a lot of sector rotation into banking right now. They're up 20% year to date, 8% for March. They're up today, and clearly what should be a down day, they're up. Why is that? Well, there's a lot of good things going on with banks. All the sell-off last year, the credit underwritings turned out better than expected. It turned out to be a fear trade more than a fundamental trade. The steepening of the yield curve, the potential for released reserves with banks, increased technology efficiency, and they still trade at a 70% relative PE to the rest of the S&P 500. So there's probably still some room to run, assuming we have an economic recovery here.
So I want to follow up on something you pointed out, though, Chris, which is the M2, the money supply plus, up 26% year over year. But one thing that we get wrong, I mean, in our economic classes, we talk about money supply, but the fact is this is just sitting on a computer. It's not the old classic kind of Germany in the 1920s inflation, or is it?
You're right. There's a lot of money in circulation right now, or at least on paper, but it's also sitting in those savings accounts and not really finding its way into the economy. You look at where the consumer saving rate is today, it's just sub 14%, well off its COVID highs, but nearly double what that rate was this last business cycle post-financial crisis, where it averaged about 7.2. So there's a lot of pent-up demand and money on the sidelines just waiting to be put to work. And with the stimulus checks hitting those consumer bank accounts here starting this week and beyond, we could see retail sales jump. Then we also look at the corporate balance sheets and sitting on about $2 trillion in cash. So a lot of money just kind of sitting on the sidelines, which could spur that growth higher than perhaps even the Fed is forecasting at 6.5%.
Dory, the 10-year yield today right around 1.7%. Are you changing your strategy at all as a result of higher yields? And how high do you think yields could potentially climb this year?
Well, that remains to be seen. We saw with the Fed a real commitment, maybe a double or even triple down on the bet that they're not going to raise rates, which I thought was pretty interesting, even amidst an admission on their part that inflation was there and they expected it to be higher than 2% this year. So how high would it get? I think it's going to be a while. I mean, there's a little comment in the bond market right now. Anything with a CUSIP on it probably isn't a very good buy in the bond market, but just because you don't get a lot of yield. So a little bit over what is nothing probably doesn't change a whole lot in asset allocation right now, because there's plenty of people that are forced to buy public or CUSIP traded bonds, no matter what the yield is right now, and that's more of the function. But you still have the Fed out there buying, a commitment to buy $120 billion worth of bonds a month. So that's going to keep rates down for a little while.
All right, Dory Wiley, President and CEO of Commerce Street Capital, and Chris Osmond, Chief Investment Officer with Prime Capital Investment Advisors. Thanks to both of you for joining us today.